What's up? I'm Dan
Hey,
Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with David. Is it Rousher or Rousher? How do you pronounce that?
Rousher.
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 Excellent, excellent. And how
Yep.
you doing today, David?
Actually doing pretty darn good.
Excellent, excellent. I am as well, and I have some great extra news here for you, David. Today, we are joined by my very favorite audience member. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate investors, syndicators, buyers, sellers, all that kind of stuff. And you might ask yourself, why would you do such a silly thing? Well, the answer is if you know about private off market, also known as 506B deals, then you might know that you need to have a documented substantive relationship, and or else the SEC will get ants in its pants. But more importantly, I think that if you're going to really succeed in this sector, you need to be able to communicate effectively. So I'm going to help you out with that, and I'm going to make sure that you understand how David fits into this business. But before we get too deep into your business, so to speak, David, do you want to say a thing or two about yourself?
Actually, I started in 1979 in the manufactured housing acquisition business.
Mhm.
And long story, my father-in-law worked for the Carlisle Group, and they were buying mobile home parks, and it's the Carlisle Group. And he was actually selling mobile home parks when I went to work for him. And I said, "Why are we doing this?" And he said, "Well, I used to syndicate." And I said, "Well, let's do that." So we started syndicating. I think our first deal was like in 1984, and it was in Brighton, Colorado. So I started there, and over the years, we've owned and managed 42 communities with about 7,500 doors, spaces.
Sure.
And yeah, over the years, I've got to be good at hunting deals down and putting them together. And so I think I'm pretty good at that. But uh, I'm not doing it sort of right now because everybody and his brother decided to get into this industry, and they've driven the prices through the roof.
Mhm.
And so there isn't anything that makes a lot of sense. So that's why I was looking at doing a multifamily. And so here I am.
Beautiful. I
Good.
love it. I love it. That's most of our guests on this show. They are in multifamily. And one thing that's important to me is that I understand if we're ever going to do business with each other, I need to understand what is going to make that syndicator investor, this person stay into these deals because they take months. There's plenty of risks involved. But before I do that, I
Yep.
gotta say, but wait. Check your rate. David, I don't know if you can see through the camera of your device and way like under there, but the user might have this hideous subscribe button down there and they maybe should, okay, it's a stupid
Yeah. Okay.
right? Yeah, just smile and nod, right? But the
Yeah,
five
I see it
distinct
now.
motivations. Let's talk about this for a second. So everybody has their own unique why, but I found that they fit pretty neatly into these five different categories. And I need to know what's going to make somebody follow through with all this. So let's talk about them. The first one, preservation of purchasing power. What's that all about? Well, if you have a portfolio of assets and the way that you make ends meet is from the proceeds of ownership, then the only reason why you're going to make a new acquisition is when inflation eats away from the purchasing power of those profits, or if you can buy at a steep discount because of distress, or if there's an asset crash. That's a great reason to be making acquisitions. That's not where I am yet. Personally, I'm trading time for wealth, and my background is in the CRM industry. I opened up a CRM agency back in 2011 and then started doing the online funnels, IT, and CRM attribution, blah, 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 for a firm in Ohio in 2014. But they were busy flipping 10 houses a month, or at least doing 10 transactions a month with these single family homes. And it hit me that I was paying way more in tax than anybody else because I was a high salary, high wage earner. And I was like, how do I pivot so that I'm getting rewarded in the form of deployed capital, AKA wealth, AKA equity? And that's why I'm involved in that. But that's a little bit too subtle for some people, especially newbies, youngsters, and whatnot. Uh, a lot of people, they get into commercial real estate because they want to own their own schedule. They want to cut back on the amount of time that they have to work, whether it's through fast tracking retirement or if they just mean working fewer months per year or fewer weeks per month. That's why they're into it. But that's in stark contrast to the next group. The next group, they're just plain ambitious. And because of that ambition, you can be sure that they're going to try and buy their entire hometown. They're after that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And that's fantastic because they're going to hustle into their 90s rather than dialing it back. Whereas the last group, they're also going to hustle into their 90s, but they've picked a sector of society, or maybe it's the environment or animals, or they want to send people to space. Who knows what it is? But they've realized that there's a financial component to that. You have to have a financial backing if you're going to make a big impact, and that's why they are making those acquisitions. So, David, of those five different motivations, what combination of those you think describe you best?
Actually, I got in the business to begin with just to make a living back
Mhm.
when we were selling mobile home parks. But I looked at it, and the people that were buying these properties were getting 12 to 18% return on their money. And I like that. And so we started doing limited partnerships, and I've kind of been doing that ever since. Over a period of time, it's built up quite a bit of wealth. We lived in Montana, and I hunted and fished and camped and didn't do much else. So for me, it was building that wealth. I was going to hand it off to my kids and say, take care of me and mom. Just give me a check once a month. And that's kind of why we got into that, into real estate investing.
I love it. I
Okay.
love it. So, yeah, so that's your big motivation doing that, and that brings me to the
Yep.
next segment here, which is the tolerance for risk assessment. If you've ever been involved in a 506B deal, then the securities attorney in the works is going to insist that you fill out this really invasive financial questionnaire. At the end of it, you're basically, the syndicator is going to know more about your financial situation than you might know about your own parents' situation. But there was one question on that questionnaire that jumped out at me because I didn't think it was very effective, and it was how much risk can you tolerate. So what I've done in here is I've changed that to a fill in the blanks question. So here it goes. There are many popular investment asset classes, but I think blank is too risky. So inside real estate, outside real estate, whatever you like, David, what's too risky for you?
You know, I think today for me, uh, it used to be RV parks, but I think today maybe buying a hotel is not my cup of tea. I don't know what the economy is going to do. Are people going to stay home? Are they going to still travel, or what's going on? So that kind of for me is a little bit too risky at this point in time.
I love it. I love it. And that brings me to the bit with the subscribe sandwich there, which is my little reminder yeah, it kills me every time. But in every episode of the Chance Encounters, I pull out the Dan Does Deals core commercial competency cube, and it's got the six different sides with the core roles in a commercial deal. And in every episode, I go through all six sides to make sure that you understand how my guest fits into the deal, and also to help you effectively communicate on the subject. If you want your own copy, just go to dandoesdeals.com. Like a complete dummy, I didn't even ask for your email address because I don't want anything in between you and downloading this and printing it out and practicing it. So let's get started. It just takes 2 minutes. The repositioner is an acquisitions person. They're looking at a bunch of properties and doing a bunch of paperwork. What's that paperwork, you may ask? Probably not. But anyway, the paperwork is called underwriting. It's a fancy word. It means doing the math, doing the arithmetic. And because they can do that, that's one of the reasons why they have the term repositioner as a name. It means they're looking through those numbers to find some upside. They're figuring out how can they make this property make more money than it is right now, but they're also doing the math to make sure that the broker slash seller is even telling the truth about how much the property is even making. Now, one of the ways that they can find upside that's very effective and a little bit counterintuitive is they spend a lot of time talking to financiers. That would be people who deal only with money and paper, and like the different loan originators, whatnot, banks, private lenders, and whatnot. And the reason why it's so important to have a huge network of financiers as a repositioner is because if you can secure a more advantageous loan, that goes straight to the profitability of the building. So they're always going to be interacting with more investors. But the repositioner more typically will look to operations to reduce expenses, stop those Benjamins from going down the toilet. But of course, there's a lot more to operations than just unclogging toilets and collecting rent and mowing lawns and whatnot. Some of the things that I bring from my skill set to the GP team is the automations and also the marketing part, which is more and more important if you have a vacancy rate problem. Even if you do outsource your property management, if you have a vacancy rate problem, you need somebody with marketing chops who can step in and make things happen. But of course, one of the problems about being a repositioner, commercial real estate's an old business, so competing purely on reducing expenses probably won't cut it with a lot of properties. So they need to get a contractor team involved to do a value add, to do some renovations, to basically make the units nicer. The idea being, if it's a nicer unit, the next resident will be more than happy to pay more in rent than the previous one. But of course, you have to be careful. You can go way too far with your value adds. There's no question about it. If you're going to be gold plating toilets, it's going to be pretty much impossible to get a return on your investment. But if you're like me, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because you can be sure that's not going to be me. I'd still be stuck at an airport in an hour or two. So you can't look at me for that part. But the locals are making sure that the contractors are keeping the schedule, they're not using subpar materials, that sort of thing. And then also making sure that the operators aren't cutting corners as well. But when the repositioner has a property in mind, let's say it's 350 units, let's say it's tens of millions of dollars, they turn around to the financiers and say, hey, got, I don't know, tens of millions of dollars you want to lend us? Well, the financier is going to have one other question that I haven't answered yet. And a lot of gurus and coaching programs, they really gloss over this part. And that's why I give specific emphasis to it. They're going to ask, who's the sponsor? Who's the KP? What's that all about? Hypothetically, you're a doctor, you're a physician, you're an engineer, you're an attorney, something like that. You get this great idea that you and your circle of friends can combine your funds, take over a local apartment complex or other commercial property. Where's the snag? Well, when you turn around to the financier, they're going to insist that somebody in the fold already owns a similar asset. So if you're looking at 350 unit apartment complexes, somebody in the fold has to already own a 350 unit apartment complex. On top of that, you need a certain amount of liquidity. And then among the ownership team, you need a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So, David, I understand that you must have done a fair bit of the repositioner part. I think you do lots of the sponsor KP part, but where do you see yourself fitting in into your next deal?
It's a good question. I don't have multifamily experience, no doubt about it. And I've already run into that issue with some lenders.
Mm-hmm.
And so boots on the ground, I'm not buying anything in North Idaho.
Right.
So that's not me.
Right.
But it's like, you want your local contractors. One of the good things that I was good at in mobile home parks is I could find the deal. And when we had issues to take care of, we had to do sewer work or we had to bring houses in, I was there making it happen. Make sure that everything was done on time and it was done correctly and it was done at 5 o'clock Friday afternoon.
Right. Okay, yes, asset management in the operations part too then. Yeah. Because that's one of the nastiest parts in multifamily is just knowing what to do with different problems, right? So I love it.
Correct.
So then my next
Yep.
question then has to do with your buy box. And when investors or syndicators are asking each other, what's your buy box? What's your sweet spot? We're really talking about three different things. The first one's geography. Where is it? Which states? Which counties? Possibly even which neighborhood? It's all going to matter. Okay, so that's the geography. The second one's size. Again, most of my guests on this show, they're in multifamily, and the way that you define size in multifamily is by unit count. And it's important because you're going to have a completely different group taking over 5 unit apartment complexes compared to the ones taking over 150 unit apartment complexes. So that size definitely matters. Of course, there's other ways of measuring other types of commercial properties, but I digress. The third part is class. And unfortunately, they use that exact same word for two different things. So I separate it into condition and area. Now, condition, it has to do with what kind of shape is it in? Is it old? Is it beat up? Is it in reasonably good shape? Is it very luxurious with all sorts of fancy amenities? Or is it basically no frills? So it's desirability, really. Now, when you're talking about area, though, you're talking about what are the school districts like where the property is located? What's the crime rate like where the property is located? And then, of course, they always say location, location, location. What they really mean is traffic, traffic, traffic. How many people go by that property on any given day? That's going to tell you how profitable that business is likely to be, as well as any indicator out there. But both the area and the condition are both ranked the same way as in grade school, where you got A plus at the top, and then A, and then A minus, and B plus, and so on. So, David, as far as what your ideal property is, what you're looking for?
I'm actually looking for a C plus, B-ish type property, B, maybe B minus.
Mhm.
That's where I see the most stable and upside potential. If you buy yourself an A property, there's not much in it other than collect the rents and raise your rents accordingly. And if you buy a C minus D property, you're probably looking at a lot of headache. And I can correlate that to mobile home parks. Um, we used to have a rating of 1 to 5. 1, don't eat before you go there. And 5 was the senior park with all the fancy amenities. And where we made our money was in the 2.5 to 3.5 star parks. So you want to stay in the middle, and that's where the families that have money, that's where they're going to congregate. They don't want to have their kids raised in I'm going to call it a lower class neighborhood, but they don't have the money to go into the $2,200 apartment. So that's where the money's to be made. At least that's my opinion.
Mhm.
So I
Mhm.
like that. And
Okay.
right now we have a couple LOIs in North Carolina, Arlington, Bayview, or excuse me, Bay City, and I've a couple deals have actually kind of popped today in Montana for me. So,
Hmm.
and I have my heart's in Montana. I used to own a lot of property there. So,
Right, right. So, and as far as unit count goes, do you have a sweet spot for that, or are you mostly agnostic depending on the
yeah,
sponsor or what you're looking for?
yeah. Well, here's the thing on that. Because I started out with small deals because way back when, if somebody called it like on one of our deals we were selling and they said, I have $500,000 and I'm calling on your property, I would give them to my father-in-law.
Hmm.
And after that happened a few times, he said, why are you giving me these people? And I said, well, he's got 500,000. And he goes, so what? And I go, no, it's 500,000. And so that was my mentality, my thinking. And what he told me, which would makes a lot of sense, is they're just zeros. And as long as they're black and fits in the box, it's a good deal. So I've learned over the years that the bigger the deal, as long as it fits in the box and they're black, go for it. Because you can always find investor partners who like that bigger deal. And I'll tell you the other thing too. When you buy a small property, say a 10 or 15 door property, you lose 1 or 2 tenants and you're upside down. But if you buy a 350 unit or 200 unit and you lose 10 or 15, you still can make that mortgage payment, pay the bills, and probably you may have to cut the distributions a little bit, but you didn't lose the deal. So the bigger the deal is, if you can put it together, let your knees shake, but put it together and do it.
Hmm. Hmm.
Okay.
Yep, I love that. I love that. That's exactly why I never ended up pulling the trigger on single family, even though that's how my boss
Yep.
was making all that money. And when I saw multifamily, it's like that protection and mitigation of risk. That was definitely what was most appealing to me. So, yeah, I definitely resonate with that message. But the next question has to do with people. And my favorite thing about commercial real estate is that because you're putting these teams together, you get lots of wild things on there. But one of the things is that we're eager to put these different teams together. We're eager to give referrals. But at the same time, because we have our own unique skill sets, we're better off helping some people more than others, or at least they'll see a disproportionate amount of gain from us helping them. So the sponsors and KPs, because I'm from the internet, that's somebody I'm always eager to talk to. And then of course the other one from, because I'm from the internet once more, is the locals, the boots on the ground. There's no
Yep.
substitute for them. I definitely need those personally. David, if you have any 506B deals, don't mention them specifically, especially in the same breath as mentioning investors. But financiers are fine, or if you have a 506C, you can go ahead. But who's out there in the camera there who you can help more than others?
What I've done when we were doing, again, my background's mobile home park. So I'm going to say this. I help the people that are starting out um, because I really like it when people stick their neck out and they're trying to get ahead and they go, how do I do that? Well, I pull my shirt collar down and say, look, see, I got a sunburn. That's because I stuck my neck out. They're doing the same thing, but they don't really know how to really do it. So I want to help those people. And so if people had five or $10,000, you're in. You own a tiny bit, but you're in the deal. And so I'll help anybody, but I really have a passion for the people that are getting into the business.
I
If
love it.
that if that answers the question.
I love it. Yeah, sure, absolutely. So, but the next part then is how to reach out. Me, I've got this super duper distinct last name, makes it pretty easy to
Yep.
find me, especially on LinkedIn, which is the social media platform I spend most of my time on. But if you use your
Yep.
phone to scan this QR code, that brings you to the FAQs page of 506BME, which is the platform I offer to document your substantive relations among your investor group, your circle, all that kind of stuff. And again, that's something the SEC insists on. And once you get to a certain amount of assets under management, you will get audited by the SEC and they will ask, how did you meet these investors? How were you sure that you knew that they could handle what you're offering? So that's what I can help there. David, as far as people reaching out to you, social media, email, how should people reach out?
Uh, I'm Dave Rousher, Rousher. My email is DROUSHER at gmail.com. And yeah, I'll give you my phone number, but you need to tell me who you are because if I don't know you, I'll delete you. So my number is 208-661-9799.
Excellent. So introduce
Okay.
yourself absolutely first as he picks up the phone. Absolutely essential. There's some
Yeah.
attention to detail. So David, I got one other thing, and it's actually not for you. It's for you in the audience. It's my public service announcement. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm really confident it's the hideous subscribe button that's just right there, and it's free to get rid of it. You just click on it and it's gone. It's amazing. And of course I want you to do it because if enough people do, then YouTube will start to pay for these videos instead of me, and I think that'd be amazing. But as far as your trade-off goes, again, it doesn't cost you anything. It just means my videos may show up on your list of suggestions, and you can go ahead and ignore those suggestions because, frankly, I really appreciate the fact you spent this time with me. Just like David, I appreciate you joining me today. This has been fantastic.
Great job. I appreciate you helping people, Dan. It's a good thing. It's a good
Awesome.
thing.
Thanks. Thanks. I appreciate it.
Okay.
Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah. It's funny.
Nice meeting you.
You too.
506BME, everybody.